name is Jim Pass, and I'm a senior managing director at Guggenheim Partners, and I manage the infrastructure investing sector for Guggenheim Investments. Sustainable infrastructure investing is an asset class that we believe at Guggenheim will continue to evolve for the foreseeable future. Infrastructure itself is an attractive asset class, but when you bring sustainability into the mix, it brings a whole new aspect of investing. And we feel through standards and different metrics, it allows us to, measure, the ESG factors and the resiliency of an infrastructure asset. And if something can be measured, it can be managed. And the more managed assets out there will allow private sector, institutional investors, pension funds, insurance companies, and so forth, become larger players in the institutional infrastructure space. Standards are being designed to measure the performance of an infrastructure asset in terms of resiliency, how does it react to climate change, and so forth. And we feel that at Guggenheim, what we're trying to do is we're trying to look at all the standards that have been developed and apply those standards or test the standards to see how they actually perform. So whether it's SURE from GIB or Envision or the Equator principles, it's very important to see the output. And as the output becomes more and more common, we feel that portfolios can be designed, or actually projects can be designed even better to offer investors greater returns. So as we believe institutional capital will start to be focused on sustainable infrastructure assets, we at Guggenheim have designed a quotient that has four components. And obviously all projects have to offer our investors a financial return that hits a hurdle. And there's also different, obviously, prudent responsibilities that we have. The other quadrants really represent environment, social, and governance. And when you think about capital and the financial quotient, we look at human capital really, and the social quotient is how does the project itself going to impact the indigenous people or the natural citizens of that space where the project may be. Additionally, when you look at the environmental quotient, you really look at natural capital. So it's really the resources of the land, the resources of what does the location bring to an asset. And then when you look at the G part, or really governance, we feel that's really is about transparency, so transparent capital. So by focusing capital in each of the different categories or the quotients, we feel that's a very unique way to analyze an infrastructure asset on a global basis. So one thing that Guggenheim believes, it really goes back to our focus on how the asset class will evolve, because there's a lot of risk, and we want to understand the risk, and so we want to examine the different standards that have been developed. And by doing so, we, along with our partner, the WWF, commissioned a study that was conducted by the Stanford Global Project Center. And they looked at all the various standards that have been designed by academic institutions, not-for-profit organizations, as well as for-profit organizations. And what we found is that there are so many standards that they're really diverging rather than converging. And so when you look at an asset in North America or Europe, for that matter, there are different standards that an investor could use or a sponsor could use, but we feel there's not greater, we need clarity. So we wanted to commission a study, and our first study was really, the conclusion was that there's enough data that can measure assets, and so that hence it can be managed. But now we want to really identify what is the best practices of the various standards. So now we're in a second phase of our analysis. We're now looking at 2 projects, and we're applying standards to those by an independent body, and then we will roll that information out most likely in the spring of 2020. So Guggenheim Partners, in the name itself, is partners is our last name. So in many ways, we feel that collaboration is a way to really help the evolution of the infrastructure asset class to be accelerated. So we have partnerships with the WWF, as I said. We also work with GIB. There's different institutional investors where we have teamed up with, as well as an organization called Goal 17, where we're trying to focus on the sustainable development goals in a way where they can be applied to infrastructure projects on a global basis. as well as, how do we measure that performance that we're helping, these goals be achieved by 2030. So given the search for yield on a global basis, I think there's a tremendous demand for infrastructure assets on a global basis, definitely in North America and Europe and so forth. And sustainability or ESG factors really have become a driving consideration for where to deploy capital. So when you're looking to make an infrastructure investment, these are one of the factors that has to be analyzed. And it really goes back on why we created the sustainable quotient, is that it's going to integrate, ESG, the social impact, the natural capital, as I described, into a financial analysis. Because ultimately, if you only make an investment decision based on financial parameters, at some point, something is going to happen, and that's going to impact that return. So by taking a step back and integrating the social capital, as I mentioned, or human capital, and then the natural capital, as well as transparency, we feel that's a better way to make an investment in the infrastructure sector. Sustainable infrastructure investing will definitely continue to be evolved and continue to be on the front page. As climate change continues to get more and more attention, you're seeing more and more, young investors, really pushing that envelope. And so I think sustainable infrastructure projects and sustainable infrastructure investing will, remain in the limelight. And how we have to institutionalize it is going to be, really the challenge. And it goes back to having, common definitions, having common expectations, which is really driven by metrics. And those metrics need standards and tools that can really produce the same result, or give portfolio managers and credit analysts the tools to analyze that climate risk, or to understand the environmental impact of an asset and so forth. So the future is bright. It's going to take a lot of hard work, but I do think it will attract a lot of private capital into the capital markets that will hopefully minimize or shorten some of the infrastructure spending gap that's needed, not just in the US, but on a global basis.